Let's try to understand revenue. For revenue, there are a few key concepts. Revenue is basically the payment that the firm receives when they sell goods. It's expressed over a time period such as a month or year. And the formula for total revenue is price into quantity of goods sold. Average revenue is total revenue divided by quantity, and marginal revenue is change in revenue upon change in quantity. Change in revenue for per unit of goods sold, and quantity change in quantity is normally 1 when we are talking about marginal revenue, because marginal revenue is the additional revenue that the firm generates by selling one extra unit. Let's look at the graphs. Revenue in different types of market. Revenue in perfect competition and revenue in of firms in other types of market. In perfect competition, the firms are price takers, means they do not get to decide what price they will charge. The market decides that so and so good will be sold for so and so price. So if we talk about a price taking firm, marginal revenue is equals to a horizontal curve. This is marginal revenue and this is the price that they have to charge. This is the demand also, and this is the average revenue curve as well. If we talk about the market, this is the supply and this is the demand. This is the equilibrium point and this is the quantity that the firms in this perfectly competitive market need to be producing, and they will be providing goods at this price. This will be the equilibrium price, and this is the point where allocative efficiency will be achieved in these markets and profit maximization will take place. Talking about other kinds of market in which are in imperfect competition, the demand curve is a downward sloping curve. We are going to look at two kinds of curves. One is the average revenue curve. This is the average revenue curve, which is never going to be zero. And another one is the marginal revenue curve, which is going to be twice as steep as the average revenue curve. Why is this curve steeper than the average revenue curve? This is steeper because to increase sales or increase revenue, as the curve is downward sloping, it means that when prices fall, demand goes up, revenue goes up. So in order to make more sales and generate more revenue, it is crucial to drop the prices further. So additional revenue generated from the sales of one more unit is always going to be less. Also, these are the two curves we will be looking at when we will be talking about profits, supernormal profits, subnormal profits, and even the types of firms that we will talk about. Firms operating in a completely competitive market, monopoly and oligopoly. When the firms attempt to maximize profit, marginal revenue needs to be equal to marginal cost. It means that the cost of manufacturing additional units should be equal to the revenue produced by selling one more unit. If marginal cost is lower than marginal revenue, it means that they can manufacture more goods to attain more of revenue. If marginal cost is greater than marginal revenue, it means that they need to produce less in order to attain maximum revenue and not lose out on some money. If marginal revenue is greater than marginal cost, it means that they can manufacture even more units to attain maximum revenue. For this table which is given, we have to see where marginal revenue is equals to marginal cost. So for the 7th unit, marginal revenue is equal to marginal cost, and this is the optimum number of units that need to be manufactured for this firm to maximize profit. We can see that at 6th unit, marginal revenue is greater than marginal cost. It means additional profit can still be extracted by producing additional units, but at 8th unit, marginal revenue is less than marginal cost. It means that the firm has gone beyond the optimum level of output, which is the profit maximization output. It is making a marginal loss on each unit at the 8th unit. That is why additional profit is negative. So this firm needs to produce at a point where marginal revenue is equals to marginal cost, and this will be profit maximization output. When we talk about profits in economics, there's a difference. We have two kinds of profits: accounting profits and economic profits. Accounting profits are the profits which the accountant takes into account and how accountant looks at profits, whereas economists, they look at profit in a different manner. When accountants calculate profit, they take into account only explicit cost, which are the physical cost, cost of raw material, and the costs that are extremely obvious. But when economists, they calculate profit or they look at profit, they put implicit cost also, which are the opportunity cost. These are the costs that the entrepreneur is already incurring these costs, but he is not accounting for it. For example, opportunity cost. He invested a certain amount of capital, suppose in manufacturing laptops, and the opportunity cost is manufacturing tablets. So while economists, they calculate their profits, they talk about implicit costs and opportunity costs as well when they are calculating total profit. That is why that makes sense where marginal revenue is equals to marginal cost. If there is a cost which is equal to revenue and nothing more, then how a profit is generated? That is why when we are talking about normal profit, it doesn't mean they are not generating profits. A firm may be in accounting profits when they are taking into account only explicit costs, but they still may not be economically profitable. Let's understand three kinds of profits in the light of whatever I explained right now. We need to know about normal, supernormal, and subnormal profits. For example, three firms are manufacturing laptops. A, B, and C are the firms, and the manufacturing cost to all of them when they are manufacturing laptops is 100,000, 110, and 90. But their opportunity cost is manufacturing tablets, which is 100,000 for every organization. For firm A, economic profit is 0, and this is the supernormal profit. For B, it's a profit of 10,000, so they should continue manufacturing laptops. But for C, it's a loss of 10,000, therefore they should stop manufacturing laptops and switch to tablets in order to make a supernormal profit but shift from subnormal profit. Subnormal profit is also called as a loss. When we look at the firms, which firm should stay in manufacturing whatever they are manufacturing, and why is normal profit so viable? Normal profit, it's the minimum amount that the firm needs to generate to survive in the country and cover its costs. That's the minimum revenue that the firm needs to generate. Normal profit is when economic profit is 0, right? And it occurs where average revenue is equals to average cost. If we look at this table, we can see average revenue is equals to average cost at the 7th unit, whereas at the 8th unit, average cost has exceeded average revenue. At this point, they are making a subnormal profit, and at this point, 0.5 and 6, they are making a supernormal profit because average cost is way below average revenue. Shutdown situation in the long run. Firms do not always make profits and they may have to endure losses for certain period of time as in corona times. And entrepreneurs often keep firms going in the hope that market conditions will change and demand for their products will increase, leading to profitability. This leads us to the question, when is the best time for a firm to shut down? There can be a shutdown in the long run and the shutdown in the short run. The shutdown rule provides the answer by considering both the long and short run shutdown periods. For example, let's have a look at this firm. Talking about perfect competition and short run shutdown situation. We have two kinds of costs: average total cost, average variable cost, and then we look at the marginal costs. Marginal cost, we know it cuts the average total cost curve. This is the marginal cost. Now for a perfectly competitive market, this is the price which is intersecting average variable cost. This is the price. This is the point where the firm should be producing, because at this point marginal cost is equals to marginal revenue, as this is the marginal revenue, average revenue and the demand curve. So at this point marginal cost is equals to marginal revenue. However, they have to cover total cost also. So basically the cost is this. When you expand it here, this is the total cost. At this point, cost to the firm is this. This is cost to the firm. The firm should be selling at P1 instead of P to cover all the costs, but the price that the firm is charging, it's enough to cover only the variable cost. In such a situation, if the price is equals to variable cost, this is a short run shutdown situation. But when average revenue is greater than average variable cost, the firm should keep manufacturing. In this diagram, there is a loss and the revenue is just enough to cover the variable costs. The question is why the firm needs to shut down in the short run and why not completely abandon operations and stop producing. That is because in the short run the firm has already paid for fixed costs, so they cannot shut down and they have to keep manufacturing. Let's assume these are three levels of output and prices for a raspberry farm. In figure A, we can see that the profit maximizing firm in a perfectly competitive market operates where marginal revenue is equals to marginal cost. For this one, we can see that marginal revenue is equals to marginal cost at 90 units with the price of $5 per packet of raspberries. The total revenue is the rectangle AOCE dash, and this is the profit. This firm should keep producing because we can see that the price is above average cost. Average cost and marginal cost intersect here, so price is above average cost. Since the price is above average cost, the firm is making a profit. Let's look at figure B, where marginal revenue is equal to marginal cost. The firm is producing 70 units while charging $3 per packet of raspberries. As marginal revenue is equals to marginal cost here, the firm is in a state of normal profits and break even. They should therefore continue producing here. Figure C, we can see that marginal revenue is equals to marginal cost at this point, which is 50 packets of raspberries, where the firm is charging $2 for one packet. However, this price is below the cost. An average cost is here for this quantity. It means that the firm is making a loss. Since the price is less than the average cost, the firm should shut down at this point. Where is the shutdown point when we look at this table? The shutdown point is always where the price falls below the minimum average variable cost. In this table, the minimum average variable cost is 2.05. If the price falls below minimum average variable cost, the firm needs to shut down. We looked at the shutting down point only with average cost and marginal cost. Now let's introduce the average variable cost curve here. In figure A, we can see that the price is above the average variable cost. The marginal cost and the average variable cost curve intersect at this point, which is below 2.2, and the price is set above average variable cost. Also, this point is not touching the average variable cost curve and lies above it. Therefore, at this point, the firm should continue manufacturing and not shut down, because they will be able to cover variable costs at least. But if we look at figure B, we can see that the price is set below the average variable cost, which should have been at least 2.2 or 2.05, as we have seen earlier in the table. So the price should have been at least 2.05. Any price below 2.05 is the point where the firm needs to shut down, because they wouldn't be able to cover even the average variable cost, which is the cost of labor. If they stop production, if they shut down production, the only cost that they would have to bear is the fixed cost, and they would have to pay that. Production at this point where price is below average variable cost is not viable, and they wouldn't be able to cover the variable costs at all. They would have to pay it on their own, which is not a viable option for any business. Long run shutdown point. We could see in this graph that the firm is producing where marginal revenue is equals to marginal cost. We extend this curve to touch the average revenue curve and see where we have the price. However, this price is below the average cost but above average variable cost. As this price is able to cover variable costs at least, this firm should continue operating and should suffer some losses in the short run to be able to survive in the long run. But if prices fall below average variable cost, then only the firm should shut down, as explained earlier also. Till the point prices are able to cover variable costs and average revenue is above average variable cost, as can be seen in the graph, the firm should continue operating.